Hey guys, welcome back to my channel. In today's video, I want to share with you my take on one of Victor Sperandeo's books, Principles of Professional Speculation, and my summary on it. Victor Sperandeo, also known as Trader Vic, is a US trader, and he traded on behalf of other notable investors such as George Soros. Back in 1987, Victor Sperandeo managed to predict the stock market crash and shorted the Dow and made 300% during a day that the Dow Jones Industrial Average fell by 20%. So if you want to learn about Victor Sperandeo's trading strategy, make sure you stick around in this video. The first thing that I want to share with you that I learned from Victor Sperandeo is about business cycles. Business cycles not only affect the economy but also the stock market. And business cycles are the direct outgrowth of the monetary and fiscal policies defined by politicians. And according to Victor Sperandeo, the periods of booms and busts are the unavoidable outcomes of the credit expansion. And this credit expansion is influenced by government policies. The booms in business cycles only progresses as long as banks keep feeding the capital availability illusion with more and more loans. And the breakdown finally occurs when banks quit extending credit or when the central bank removes reserve from the system and effectively slows or stops the credit expansion. This is an important point to take note, that the monetary policies implemented by both the government and the central banks are designed to encourage the extension of credit, and this will tend to generate a business expansion, but only at the expense of an unavoidable recession. So what Victor Sperandeo is trying to say is that the monetary policies that are being implemented, yes, it will help the economy grow, but at the same time, because of these monetary policies, recessions are unavoidable. And understanding this macro picture as investors and traders will help us better navigate the stock market. The second lesson that I learned from Victor Sperandeo is the 4 phases of the market. There are accumulation, distribution, trending up or down, and consolidation. The first is accumulation. When a stock is being accumulated, it is being acquired gradually by investors. And for distribution, the opposite is true. The stock is sold gradually by investors. The question then is, how do we determine when the stock is being accumulated or when the stock is being distributed? To determine whether a stock is being accumulated or distributed is we want to see where prices break out from. If the stock breaks on the upside, this means that the stock is being accumulated. And if the stock breaks on the downside, it means that it has been distributed. When a stock is being accumulated or distributed, a stock tends to trade sideways for a while. When a stock trades sideways for a while, the stock usually trades within a range. So there's an upper range and a lower range. If prices break on the upside, then we say that the stock is being accumulated. But if the stock breaks on the downside, then we say that the stock is being distributed. And that is how we tell the difference between accumulation and distribution. The third phase of the market is trending up or down. And Victor Sperandeo defined an uptrend as a series of higher highs and higher lows, and a downtrend as a series of lower lows and lower highs. To illustrate this to you, this is an uptrend. So there's a series of higher highs, so this is the high and this is another high. So prices are making higher highs, and this is one of the low and this is another low. So prices are making higher lows. When prices are making higher lows and higher highs, we say that the stock is on an uptrend. And for a downtrend, this is how a downtrend looks like. This is one high, this is another high. So prices are making lower highs. And this is one low and this is another low. And in this case, we see that prices are also making lower lows. When prices are making both lower lows and lower highs, we say that the stock is on a downtrend. And that is the third phase of the market. For the fourth phase of the market, it is consolidation. And Victor Sperandeo defines a consolidation as a stock adjusting after profit taking in a confirmed trend. The third lesson is how Victor Sperandeo draws his trend lines. There are 2 steps to this process. The first is selecting the period, and the second is determining whether the stock is on an uptrend or a downtrend. Selecting the period is determining whether you are looking at it for the long term, the intermediate term, or the short term. Long term is anywhere from a couple of months to a couple of years. Intermediate term is a couple of weeks to a couple of months. And then short term is a couple of days to a couple of weeks. The first step to drawing a trend line according to Victor Sperandeo is selecting the period. For an uptrend, we want to draw a line from the lowest lows up to the highest minor low point preceding the highest high, such that the line does not pass through prices in between the 2 low points. And after we got that line, we want to extend the line upward past the highest high point. That's quite a lot of words. So we'll take a look at an example. Over here, this is the lowest low point, and this was the highest low point. The next step is drawing a line across these 2 points without cutting through prices. That's how to draw a trend line in an uptrend according to Victor Sperandeo. The next is drawing a trend line in a downtrend. Victor Sperandeo mentions that we want to draw a line from the highest high point to the lowest minor high point preceding the lowest low, such that the line does not pass through prices in between the 2 high points. And once we got that line, we want to extend that line past the lowest high point downwards. Again, let's take a look at an example. Over here, this is the highest high point, and this point over here is the lowest minor high point. We connect the two together and we get our downtrend line. The fourth lesson that I learned from Victor Sperandeo is identifying the change of trend. And I think as investors and traders in the stock market, this fourth point is especially important for us. Because if we are able to identify the change of trend, we are better able to maximize our profits in the stock market. And according to Victor Sperandeo, there are 3 steps to identifying a change of trend. The first step is that the trend line must be broken. So earlier on, we have seen how Victor Sperandeo draws his trend lines. If prices break the trend line, that's the first step in a possible change of trend. The second step is that prices must stop making higher highs in an uptrend or lower lows in a downtrend. And the third step is that prices must go above a previous short-term minor rally high in a downtrend or below a previous short-term minor sell-off low in an uptrend. For the first criteria, the trend line must be broken. So this means that prices must cross the trend line drawn on the chart. So in an uptrend, prices must cross below the trend line, and in a downtrend, prices must cross above the trend line. The second criteria is taking note of whether prices are making higher highs and lower lows, depending on the trend in which the stock is in. For example, in an uptrend, after a minor sell-off, prices may rise again. But if prices fail to carry above the preceding high point or barely breaking above the high, this can indicate to us a possible change of trend. And the converse is true for a downtrend. In a downtrend, if prices fail to make lower lows, or if prices barely break the lows, then this could signal a potential end of a downtrend. And the third and final criteria to identify a change of trend is that we want to pay attention whether prices go above or below a certain price point. In a downtrend, prices must go above a previous short-term minor rally high, and if prices are on an uptrend, prices must go below a previous short-term minor sell-off low. Now let's take a look at an example of prices changing trend and the 3 criteria to take a look out for. On the left side of this chart, we see that prices were on an uptrend. So we draw a line connecting the lowest low over here to the low of this high point over here. And then we extend the line across. And the first criteria to identify a change of trend is when prices break the trend line. So in this case, prices break below the trend line. So that fulfills the first criteria. And over here, prices fell and did not manage to make a higher high. So that fulfills the second criteria. And after that, prices broke below the previous low at this line over here. And that fulfills the third criteria. Because prices fulfill all 3 criteria, this confirms a change of trend. And those are the 3 criteria that Victor Sperandeo pays attention to identify a change of trend. The 5th lesson from Victor Sperandeo is the 2B rule. The 2B rule is a special case of criteria 2 that we have seen in the 4th lesson that we have learned from Victor Sperandeo. And that is why we have the name 2B. And for the 2B rule, prices must stop making higher highs in an uptrend or lower lows in a downtrend. And more often than not, if prices fulfills this criteria, it signals a change of trend. In an uptrend, if prices penetrate the previous high and fail to carry through, and then immediately drop below the previous high, then the trend is apt to reverse. And the converse is true for a downtrend. So for Victor Sperandeo, sometimes he doesn't wait for all 3 criteria to identify a change of trend. If he sees prices fulfilling the 2B rule, then he might act on it even before all 3 criteria are met to identify a change of trend. So the 2B rule states that in an uptrend, if prices fail to make higher highs, then the trend is likely to reverse. And in a downtrend, if prices fail to make lower lows, then the trend is also likely to reverse. This is an example of Victor Sperandeo applying his 2B rule. So on the left side of the chart, we see that prices are on a clear uptrend because prices are making higher lows and higher highs. But at this point over here, can you see that after prices fell and then it rallied back up to the previous high, prices failed to make a new high. And because prices fail to make a new high in an uptrend, this meets Victor Sperandeo 2B rule. And this signaled to him a possible change in trend. And then we can see after that, prices did indeed fail. So that is the 2B rule. That's my summary on Victor Sperandeo's book, Principles of Professional Speculation. What is the one takeaway that you got from this video? Let me know down in the comments below. If you have learned something from this video, smash the like button because it will really help the channel grow and allow me to produce more content such as this. And if you are new to this channel and haven't already subscribed, make sure you subscribe to this channel because each week I release new videos about investing, trading, and the stock market. I'll see you in those other videos. To your financial success.